Well, welcome to another episode of the Wealth Alchemist. Kevin Dick, CEO of KDI Wealth Management here. And with me today, I've got Kyle Pugel. Kyle, how are you?
Good. Thanks for having me.
Yeah, of course. A little bit about Kyle. I've known Kyle for a very, very long time. In fact, I've got some great stories that I won't share, but some stories I can share. I still remember I had some knee surgery, and Kyle was in high school, and he would come over every day after class, and we would play video games for 2 weeks until I was healed.
Yeah.
That's where the bonding all happened.
Modern warfare, shooting out of a helicopter.
It's pretty hard not to bond when you've been through modern warfare together in video game.
Yes.
So Kyle's with Guaranteed Rate Affinity Mortgage. That's a mouthful, I know. But the important thing to remember is if you Google Kyle Pugel or go on LinkedIn, you will pretty much find him. I don't know if there's another Kyle Pugel, is there?
No. Not to my knowledge. I found a Chris, and we connected on Instagram to see if we were family built or not.
Nice.
I'm the only Kyle that I know.
So Kyle, we all end up getting into business. I think some of it's luck, some of it's by design. How did you end up getting into the mortgage business?
100% by design. I started kind of by accident, but eventually I know it was like my dad kind of led us down that path. So going into high school, I was playing varsity basketball summer before. One of my sister's friends actually hit me with a four-wheeler, and so I couldn't play summer league basketball on the varsity team. So what my parents offered me for my 18th birthday was a 9-day crash course to get my real estate license. What 17-year-old wouldn't love that, right?
Absolutely.
So I spent my summer before my senior year. I knocked that out, couldn't play basketball, ended up getting my license right before my senior year, and then went to college. Did an internship with a company that was actually flipping apartments and renovating them into condos, so I've got some experience there. I worked for some banks, but my sister actually led me into mortgage because she did an internship with a lady in Payson that you know,
yeah.
and learned from her, and I saw what she was doing, and I was like, you know, this is something I could do, and we ended up making that jump in
It's a
2012.
family affair.
Yeah.
That's great. Yeah, Casey does a great job. She works with a lot of our clients up in Payson and has always done great work, as have you. It always helps when you know somebody really well and you know their integrity and you know how they do business, which, of course, we know that about you and your family.
The interesting thing about that is my sister and I, well, my parents owned the real estate company, right? But neither one of us worked with the agents at the real estate company because they had their preferred lender, who was the lady that taught Casey.
Yeah.
So Casey had to go out on her own and build her own business.
Had to build it from zero.
And the same happened when I got into business. I built it up, and now my sister and I always ran independent, still in the same business, same company, but running our own book of business, and now we work together as a team for like the last couple of years.
And that's the way it should be. I came into this business via my father-in-law. He brought me into the industry, but then when I went independent, I had to build it all from zero. And there's really, I mean, you get your pride and you get your, frankly, you learn better when you got to cut your own teeth and
You have to be the one knocking on the doors.
make your own mistakes. And yeah.
Well, we both took two different paths and ended up in the same spot, right? Casey came into the business as an intern, and she learned from a mentor, and everything, just absorbed her knowledge and basically copy and paste what she did and how she built her business. And then I came in through a call center. So I was on the phone for 10 to 12 hours a day, outbound calls. I mean, there was the day that it hit me that I was like, okay, I need to get out of the call center. And I called this one lady probably 12, 13 times, and she answered, and she just laid into me. And I was like, okay, maybe the call center is not my environment, but you learn really good skills in that environment.
For sure. It's like, drinking through a water hose or fire hose.
Yeah.
So tell me a little bit about your role now within the mortgage space. You know, what is your actual role?
So my title is regional president. I oversee Arizona, Colorado, and Utah. We have about 50 loan officers between the three states, but I also still produce and run my own book of business.
So that's a lot.
Yeah, and there's a story behind that because I always joke with people when we're recruiting or talking with the loan officers that you haven't really been in the business yet until you show up one day and your company's closed, because that happens more frequently than you would think. So what happened, it was about 90 days out from my wedding, and came in and they're like, okay, well, this is gonna be your final day. And that was it. And they shut down the entire company, the entire division that we were in. And the company I was working for at that time, I was a regional manager. They didn't allow us to produce. So I'd actually given them my book of business. I'd gone into this role for a few years and then was let go. And I started over again. It was August 8th of 2016. And I was like, well, I know how to be a loan officer. I'm going to go be a loan officer and build it back up.
Wow. That's so nice you did it twice.
Right. But you're about to get married and you're like, hey,
that's
starting
funny.
over.
You know, it's when I was at Edward Jones, they teased me because I opened 3 offices. And nobody does that. Because each time you move, you're only allowed to take a certain percentage of your current clients. Or at least you were at the time. I don't know if that's changed now. I can't speak to their current policies. But at the time, we weren't allowed to take everybody. You could take a few of your core clients. And then you did it over again. And everybody's like, do you just love knocking on doors and meeting new people? And well, yeah, actually, I kind of do. I mean, I love that part of the business and growing it.
Funny, when you go back to that point, there's almost like a new fire that's lit, and it's new and exciting, and it's all new people, and you're like, all right, let's go get it.
Yeah. It's like, yeah, you get reinvigorated. So, kind of curious, what's one of the best stories around mortgage, or maybe one of the craziest mortgages you've ever seen?
I've done, I think, somewhere north of 1,200 mortgages, and there's always a few that stick out.
Yeah.
And there's one in particular, the guy, you coach your clients, right? There's certain things you don't do during the mortgage process. You don't go take out new credit cards.
No.
You don't go buy your appliances before you have the home. Even if they're giving you 0% interest, like, you don't do that. You don't go buy the new car. I know you have a new garage, but you don't need a new car yet. You don't quit your job. And we have these automated emails that go out, and you prep these people beforehand. Don't do this. Automated email goes out. Your mortgage is approved. You have final approval, right? So this guy is like, all right, I'm all done with the process. Goes in, quits his job, and he didn't do it like in a good way. He went out guns a-blazing, pretty much telling his boss, like,
take this job.
Yeah, exactly. And so we do the final verification of employment. He is no longer employed, and we tell him, like, okay, you don't have the income anymore. You're not going to get the loan. Right. And so he went back begging for his job back, and because of the way he quit, the employer just said, not happening. So unfortunately, that cost him the home and his job.
I think before you take any of those steps, you better have all the money in the bank you need for everything.
Maybe an emergency fund, or if you're quitting your job, a few months' expenses, or have another job lined up.
So what are some common mistakes perhaps that that high net worth clients could make in a mortgage process? I mean, a lot of times when you have high net worth clients, either they're business rich, like they've got a lot of value in their company, but maybe not in their own accounts, and or they have these low basis, high appreciated assets, so they're still borrowing money, and they've learned that leverage is a tool. So what are the differences in mistakes you might see high net worth people make?
So in that realm, there's a lot more options because they do have assets. There's programs available to make things work. But with your high net wealth clients, I find that it's one of two things. So like you said, they already have a lot of money accumulated in investments, or they're self-employed. And so oftentimes when you're self-employed, you make a lot of money, but you're willing to pay an accountant a lot of money
to make it look like you don't make a lot of money.
You don't make a lot of money, right? So then when that's the case, your traditional mortgage avenue is not available to you anymore. So we have to look at alternative options. But that misconception is, hey, I make a lot of money, this should be a no-brainer, or really we have to be more strategic with how we're structuring that loan, or what kind of program we're using to actually make it work.
Wow. And I'm sure when you're going down that road, there's a lot of education on your part for the client. So since we're going down this road, X, Y, and Z need to happen, and we need to see different types of documentation.
Yeah, it just depends on what their setup is. Self-employed, for instance, I have one guy right now, he's self-employed, makes a lot of money, but took a hit in the most recent year. So because of that decline in income, there's an issue. We were able to pivot from a traditional jumbo loan to what's called a non-QM loan, where we can qualify just off the most recent year. So that was the difference between him getting a loan and not getting a more traditional jumbo loan versus what would be available today. And then when you have your high net worth people that just have a lot of assets, you can actually use asset depletion programs, where it's just a formula. Say you can use X amount of these assets and make an income stream essentially.
Okay.
Sometimes it requires them to pull assets depending
Just
on
start
the type.
pulling so they can demonstrate it?
Yeah, but there's also programs where you don't have to touch it at all. So it just depends on where the assets are and the age of borrowing.
So again, I guess, as in many things, we're a who, not how kind of operation. The key is go to the right who, somebody that, like you, that has the knowledge, and start there before you even begin the process. Maybe even before you start to look.
It's advisable. Like, the sooner you can connect, the better, because you can put a plan in place.
Yeah.
It's the people that have the most frustration that decide, hey, I'm going to go buy a house. They wake up Sunday morning, they're like, I'm going to go buy a house, and they are out there at 10 a.m. saying, I'm ready to write an offer, and they haven't talked to anybody, they haven't run anything, they haven't looked at credit, and then for those people, it's typically the most frustrating because now they're trying to figure everything else out at the last second.
I think I can relate to that in my younger life. I think I might have actually called you in my younger life.
Have you made those calls?
With something like that.
I could see that.
Yeah, where there was an opportunity too good to miss, and how do we get this done?
Not that you shouldn't do that. It's just, if you have that inkling that you're gonna buy, like, get your plan in place as early as possible.
So I think you kind of addressed what my next question was, and it's, how does it differ, the process, when you're buying a multi-million-dollar home versus maybe a more traditional, let's say $1 million home. I'm going to buy a $10 million home versus a $1 million home. You're already probably talking about non-conforming loans, but what other hiccups might come along in a transaction like that?
If we were having this conversation several years ago, there'd be a lot more complications, but with the way the market has evolved and products have evolved, it's not as different as it used to be.
So there's a lot more multi-million-dollar homes on the market,
That's
right?
true. You have conforming amounts going up, but actually there's a lot more solutions today than what there were, because if you look back at 2008, mortgage products completely changed. It became very vanilla, very strict, and we've gradually continued to loosen up as time has gone on, where you can do like a 1-year tax return or a 1-year 1099 program, or there's multiple asset depletion programs based on different formulas. So there's a lot more flexibility, I would say.
When do you say it might make sense to still have a mortgage even though you've got all the money to buy the house?
It depends.
It depends.
It depends.
It's a great answer.
So this is really a one-on-one conversation we have with a lot of people, and I think it really depends on where you're at in life, where you are, what your relationship with money is, what your relationship with leverage is. Because I'll give you myself for example, right? I go out and buy a car. My first car, I put a loan on it. My payment was ridiculously low. It was like $230 a month. But there was something about having that payment,
You
and
had to get rid of
I
it.
had to get rid of it, right? So for me, there was something emotional there that I just had to get rid of that on my car. And so for me, the right decision was to get rid of that so I could mentally relax.
Yeah.
Versus mortgage on the house, I don't see as a big deal, right? It's just it's just another financial tool within the whole portfolio that we're using for our home.
Right.
And so it depends on a lot of things when you have those conversations with people. I think if you have really good credit and you have money in the bank, a lot of times it still doesn't make sense to pay 20% down. If you can get really inexpensive mortgage insurance, where
Right.
we just did one, it was like $24 a month. So for $24 a month, it makes way more sense to put 5% down, pay that premium, and keep the other 15% with your financial advisor. Why put it in a home? The other thing is, if you think you're going to need the money down the road, it's a lot harder to get your money out of the home
house,
than
yeah.
it is to get it in there. So once it's in there, now, if you need access to it, you're going to pay fees or refinance costs or whatever it is to get back at it. So keep the money where you can control it.
It's really interesting that you bring that up, because a lot of folks think, well, I have that money in my home. Well, a lot of times when you most need that money, everybody needs that money, like recessions or worse, but can you really get the money out? Because there's a strong likelihood that they're going to tighten things up for everyone at the time that you most need to get that money out. So yeah, I totally agree with that. Interesting. And what are the trends that you're seeing in the market right now? We always hear the housing market is up or the housing market's down, it's tightening. I know that your region, so basically your region Southwest, and some of it's the Sun Belt, some of it's a little more north, but we're probably one of the most affected from recessionary times and things like that. So what are you seeing?
I'll just speak for Arizona, because I do most of my business in Arizona. We're seeing a lot more negotiating. We're seeing sellers willing to bring are willing to reduce price. We're seeing sellers willing to buy down rates. We're seeing sellers willing to pay closing costs to attract more buyers. So for buyers, it's a good thing right now, and it's something that really hasn't been on the table for several years. So if you're thinking about it, this is an opportunity to have a seller help pay for it.
Is that something they actually put in their listing, or does that come up in the negotiation?
Some will do it in the listing, some will just come up in the negotiation. You actually see it as something that you can advertise. For instance, you could do a 2-1 buy down, which is just a temporary buy down of your interest rate. Typically runs 2 to 2.5% of the loan amount. It's something a seller, it only makes sense when really a seller offers it, but a seller can offer it to the buyer to temporarily reduce their payment. So that money just goes into a side account. It subsidizes that monthly payment for the first 2 years.
Wow, that's very creative.
Yeah.
I don't know if you know this, I'm in the process of selling a house right now, so.
Oh, okay.
That's really good to know. Yeah.
Well, from a selling standpoint, right, you probably net very close to what you would with a price reduction, but from a buyer standpoint, you're helping them with their monthly payment, which for most of us, our monthly cash flow is what most impacts us.
Yeah.
So that's why it is attractive.
That's why the car salesman always says, "What can you afford?"
Exactly.
What's your monthly payment you can afford?
Yeah.
And
And it's
work
still a
backwards.
30-year fix or whatever you lock. You can do with a 7-1 arm or 7-6 arm.
And anything different? It's interesting when clients bring it up to me. I always talk about the interest rate, the cost of the house, because what's going to impact the payment the most?
Interest rate.
And the interest rates are still at historically low numbers, or fair, very reasonable numbers. I think if you're making a life decision and it's your dream home, or outside of being out of your own personal budget, I don't know why you'd wait. That game's never worked for me, trying to
I think,
time.
so there's a whole generation, I know you said it's like historically low or moderate rates, right? But there's a whole generation that doesn't understand that.
They believe they're supposed to be at 3.5.
100%. And so that's
where they grew
a
up.
conversation we have all the time.
Yeah.
Like my first mortgage was 2.375 or 2.5%, right? And I had to mentally overcome that hurdle. But
Yeah.
I see that same with our buyers, right? They don't accept this as normal. It's starting to become normal, but it's been several years in the making.
I had a builder, client of mine, we were having a conversation, built a lot of homes. And he says, here's the thing that you need to realize about the values of homes right now. Try and build one. The material costs, the cost of appliances, it's not just that what people are willing to buy or take for a home has gone up. It's the actual costs of building a home have gone up dramatically over the last few years. Just the lumber, the materials that go into a house. So, I mean,
Seeing
those
that
are the
in
inflationary periods. What's that?
I would say we're seeing that in insurance rates too.
Oh my gosh. I mean, that's another thing that folks really probably should take a look at when they're buying. First of all, can you get insurance?
Mm-hmm.
If you're in an area where perhaps the insurance companies are leaving, and if so, what is that cost before you buy a house? Are you going to be able to swing both the house and the insurance cost?
It's a big deal. In the past, it really hasn't been a big deal. People wait till the very last second. No big deal. Insurance, we'll get it in. But now you're seeing it really for the last year or so, where just like you said, it's a concern like, will I even be able to get insurance? Is one thing, but people don't take into account what that premium is going to be, and they see it and they sometimes get sticker shock. So it's something important you look at early in the process.
It's interesting. We had one of my great childhood high school friends lives up in Colorado, and his home was lost. And he was in one of those groups whose insurance agent had not been keeping up. And he ended up having to come out of pocket hundreds of thousands of dollars to rebuild his home, in addition to his insurance. So what I suggest every client do, every person do, if you own a home, make sure that your agent is actually looking at the value of your home every year. Don't just take it for face value that they're doing that work. Call them and ask, have you revalued my home? Am I insured adequately?
And we do that at the time of closing, but it's not kept up on by the lender. It's important that insurance agents look into that as well.
Yeah, kind of an ongoing thing. Home ownership is not for the faint of heart. I mean, you do have to, there's some work in it, but I think the payoff is there. We've done very well over time by owning real estate and kind of taking the next step when you can. And it's been a lot of fun. Any opportunities that you see from your side of the business when you're collaborating, let's say with a wealth manager? Because I'm sure a lot of times you end up talking to those folks when you're in the process, and maybe they even say, hey, just talk to my advisor. Any collaborations you see there that are beneficial for the client's sake and or for the way that those outcomes happen all together when you're going through a loan versus just one-on-one with maybe an inexperienced buyer?
One, I love it when they have a financial advisor and a CPA, people that they know. And
Yes.
I really like it when they're like, just work with them. So as long as I have consent, it makes it easy because I can go directly to the advisor and say, this is what we need. Advisors know exactly what that is,
Yep.
and they can get it over. Because otherwise you find clients trying to like log on their online portal and they're like, I don't know what this is or where to find it, or let's just connect us, we'll do it. But I think it's really important to bring a financial advisor in on the picture if you have one, because a lot of times they will just validate what we're advising as well, and they typically, you guys have a lot longer relationship with clients typically than what we do. My sales cycle is typically 90 days, so
Right.
that's my relationship. But if I can tell them, hey, this is what I would do based on my experience and recommendations, and then we take it to the financial advisor and they're like, yeah, that's what you should do. I think that's one of the best parts of collaborating is the validation and the trust that comes from that.
That kind of leads me to another question then. So probably your number one client is probably real estate agents that trust you and know you're going to get their deal done. Is that accurate?
Real estate agents and past clients.
And past clients,
Yep.
yeah. And the average American now buys a new home how often? Is it 3 or 4 years?
Probably a little bit longer than that. I think it's actually skewing longer now because people are holding on.
Oh,
People are doing anything to hold on to those rates.
yeah, that's true. We said we were going to have a much tighter market. You know, our industry did anyway. Like the Journal and everybody was reporting that real estate was going to get super tight because people weren't going to leave these houses. But what we're seeing is there's plenty of inventory, right, for folks who want to buy a home.
Yeah, we have people buying homes all the time. I mean, maybe you have to. I mean, no, there's plenty of homes.
Yeah, I haven't seen the crunch that everybody talked about. Hasn't really come up.
I think part of what you have, like, if you have a demographic of first-time home buyers, they watch too much TV and Instagram, and they want that dream home the first time out. And really, you need to have expectations. It's going to be your starter home. It's not going to be the Instagram home. To have just like realistic expectations.
It can be the Instagram home if you also watch the DIY Instagram posts.
There you go.
So that you can fix your place up, and we did a ton of that. My wife, Carrie, you know Carrie very well. Our very first home was a HUD repo.
Okay.
It was $110,000, and they gave us $14,000 to do all the repairs. So we had to put a new garage door on, we had to put a new front door in, new windows. Long story, person had been murdered. They didn't know if it was in our exact house or somewhere else, but they knew that was where she lived, and it actually was very public. If you Google just a few of those things, you can probably find the house and find the story. They ended up finding part of her body out in the desert. But kind of a fun part of this, not this horrible experience, we were moved into the house. I was checking the mail the first time after we'd gotten all the work done, and a gentleman meets me at the mailbox and says, hey, I don't know if you know this, but a woman was murdered there. I said, really? This is when I found out. After all this work, I said, please, if you see the little blonde, cute lady that lives with me, my wife, please don't tell her this story. An hour later, Carrie walks in the door and she says, did you know that someone was murdered in this house? I said, where is that guy? His wife. He had not told his wife. His wife saw Carrie, walked up and said, hey, we're so glad you guys moved in. The house looks great. Especially after that story. So anyway, we stayed there the exact 2 years we needed to. Okay. And sold that house. So yeah. That's another way that some of our clients' kids, there's still some of those HUD programs out there, aren't there? Where they can get in.
Yeah, there's renovation programs, there's HUD programs, it just depends. So there's a $100 program too.
$100 program?
Yeah, it's foreclosures that have gone back to HUD that you can buy for $100 in certain demographics if you are like a teacher, a firefighter, policeman.
Wow, that's good to know.
Yeah. You don't see it, it's not common now, but it was several years ago. Far more common when there was a lot more foreclosures and short sales.
You grew up in Payson. You know, we've lived and had a home in Payson now for 22 years. And that market's gotten so tough for teachers and firefighters and police. I mean, it's just gotten so expensive. That would be interesting. What one thing that you think is the most commonly misunderstood part of getting a mortgage?
And if you own a home, that you're automatically going to qualify.
Ooh.
Yeah. You see that all the time because if your income changes, life changes, right? And what you were qualified for originally could be completely different than what your picture is today. And so we see that all the time where people they'd be calling like, I need a pre-qualification. Okay, we just need an application. We need these things from you. Like, well, it doesn't matter. I already own a house. It shouldn't be an issue at all. And it's like, maybe.
Yeah,
right? Just because you own the home doesn't mean things have changed.
We've seen the same thing with business owners. You know, it's kind of like, well, I'll take it back to this. When we're helping a client who may be selling a business, we look at EBITDA, and then we also look at adjusted EBITDA, which is all the things that you threw in there to make it look like you didn't make money, or like you put your auto in your business, and so you're paying it through the company. Well, then when you go to sell the business, it makes it look like it doesn't have as much value, so you need to get it back in there. Well, there's the same thing that kind of goes with getting a mortgage. When they're looking at and going back to what you had said about EBITDA, and so we see the same situation when they're going to sell their business. They say, oh, I should be able to sell this for X. No. And so we always tell them, start 3 to 4 years out from when you're going to sell your business, and let's start working on EBITDA and getting it healthy and fat and getting the things out of it that maybe you don't want in there. Additionally, you know, what I think I've heard you say now a couple of times in different ways, the time to talk to a mortgage person is not once you find the house. When you know you're going to start looking, sit down with somebody like you, go through the application process, say, what do you see that you like, what don't you like, what can I fix before we get into the process to make this look better? Does that sound reasonable?
Yeah, like if you even think you want to buy a home in the future, just connect. It's no cost, no obligation. It's credit income assets. It's a soft credit pull, so no impact on your credit. And it just gives you kind of an idea of where you're at in the process. I just closed on a first-time home buyer recently, and I've been working with this lady for 2 years. She had gone through a divorce, never bought anything on her own, and she was starting at the ground zero. Didn't have good credit. We showed her the credit improvement plan, and here we are. Fast forward 2 years later, she just got the keys, and so she's super pumped. She wrote us a rave review, but what people just see the closing, but what you don't see is all the work that she put into it because she had the foresight to know that she wanted to buy a home eventually. So
that's very cool. That's a great story.
If you think you want to buy a home in the future, just look at it.
Well, and you and I have just recently, you and I talked, and frankly, this goes back to your character. You actually referred us away to somebody you thought had a better fit for this circumstance. But basically, we were taking the assets that are in the current home to leverage to buy a property and build on it. And so there's like 3 layers through this. There was a solution, and you knew of the solution. We just ended up going a different route to get it. But you were very integral in making that happen for the client.
I even had an option to pull the assets out, and I said you shouldn't do it. You should just go with the other.
Just go with it.
Yeah,
that's
so streamline the process for you.
So good. So Kyle, how you and Casey really kind of work together? Casey's kind of the Payson area guru, and you handle most of the stuff in the Metro Valley. How do people get a hold of you if they want to?
Instagram. No.
Instagram. Hey, by the way, if you haven't seen his Instagram, Kyle Pugel. I would check him out. His LinkedIn. He's got some posts on LinkedIn too. Pretty creative stuff.
So it is. It's fun. It's a lot of work. Easiest way. You can Google us. Jump on our website, thepugelteam.com. We both have the same cell phone number, so call, text that number, or the inbox.
Excellent. If you need to get a hold of us, go to kdiwealth.com, or you can just get us through our 800-877-474. 4350, and no bad questions. If we don't have great answers for you, we'll get you to somebody who does, somebody like Kyle or some of our other guests. We believe it's who, not how. If you have the right connections and the right people who in their field, they make you look really good, and everybody wins. So thanks for joining us today, and we'll see you next time.